What's going on, everybody? Michael Silva here. You're watching the Stock Market Brief Show. We're going to talk about stock market bottoms today and kind of uncover the common thread between today's potential bottom that's forming. We're going to talk about the bottom here in the dot-com bubble, and then we're also going to talk about the great financial crisis bottom in today's Stock Market Brief Show. We're also going to be giving out daily expected moves and get a good idea as to where price may head the following day. Now, we're going to go ahead and get right into it today. What took place in the 11 sectors that make up the S&P 500? Tech led the way, and we had financials and energy at the bottom. Now, taking these hits down towards the bottom, you take a look at the S&P 500, and it remained rather flat. Why did it remain flat? Well, because technology saved it from falling further. You can see that in the heat map here, too. We had big tech days. You know, tech has been kind of the flight to safety, which I'll show you more about that momentarily. And then financials like Bank of America and Charles Schwab down another 6% today, just getting crushed. These two were down 2% yesterday. They're down another percent today. You can take a look here at XLF. It's sitting right at around those lows. You're looking at KRE is down again today, sitting right around those lows. It's actually a new closing low for the regional bank. So it's a very still volatile and dangerous environment. Energy backed off a little bit too from that 200-day moving average, which basically tells us that IWM is not going to have that great of a time. Why? Because they have a lot of those regional banks and energy names. So it's just sitting right here, looking pretty similar to the KRE chart. Okay, now the Qs, tech, right? Qs had an indecision day and it's trading within this. So we have an inside trading day, indecision candle. Basically, markets move between expansion and contraction. So right now we're coiling up. Are we going to start breaking to the upside and the S&P 500 is going to be saved? Or are we going to take a little bit of a backseat breather? Well, time will tell. We need to look at the 15-minute time frame and kind of take a look at how today's price action played out. Take a look here how we closed the day here on yesterday's trading day. This was the daily expected move, okay, for today's trading session. We gapped up through that candle, so a big gap up, and then all this excitement right out of the gate, creating what's called a lower high. And then you can see price after that point went sideways, and we gave back that JWAP, which is the Jerome weighted average price, just anchoring a VWAP to when the meeting came out. And you can see price came all the way back down, getting below the opening point of the day and almost back here. So it was a pretty bearish looking day, very volatile. And we had this little bounce back up into the JWAP, and we closed within the daily expected move. Remember, these expected moves, 68% of the time, they close within it. That's just if you're thinking of it as in terms of a bell curve. We're going to continue on now and kind of talk more about the stock market bottoms. Now, remember this slide. This is the sector rotation slide, and it's showing us in orange the stock market, right? So this is the stock market cycle, and in blue, the blue is showing us the economic cycle or the business cycle. And what I want to call out here is as we are moving down into the business cycle, we start to try to find bottoms and relative strength in a couple of sectors. Okay, this is nothing new. If you're new here, then it is new. If you don't want to be new here and you are new here, make sure you subscribe. Technology, communication services, and discretionary typically lead the way. Well, if I just look at year-to-date performance, these are performing very well. So discretionary, communication services, and technology, they're all doing well from a relative standpoint and an absolute standpoint, really. And you can see, like these names over here, the safety names, staples, healthcare, utilities, are lagging quite a bit. Okay, so if I take a look at the S&P 500, you can see here, yeah, October was the current bottom. We don't know if that's going to be taken out or, you know, we come back here and test it, which I'll show you these other bottoms, how, you know, volatile they get. So it takes time. But what I'm trying to say here is we could be coming very close, you know, maybe the third quarter of this year where we can actually have a confirmed bottom in the economic cycle, which means that there's a bottom in the stock market cycle there too as well. So if I go back over here, I want to call out, okay, well, what happens at tops, right? So energy, consumer staples, utilities, as you make that turn, those typically, you know, start to perform worse, or those are, not worse, they're the typically better performers, and you have discretionary not perform that well. And in 2021, late stages of 2021, going into 2022, we called that out so many times. And you could see here, if I look at the dates from, you know, early or late 2021 into 2022, what were the leaders? Energy, staples, healthcare, and utilities. And what was the lagging quadrant? Discretionary. So it really helped see from an intermarket perspective that we could very well be at a top here in the market, which we just so happen to be. Now, I want to talk about the SPY back in the dot-com bubble bursting. So the dot-com bubble burst and you can just see this massive volatility, this retest came back. It didn't actually make a new bottom, but it did come down pretty far. But then throughout this stage over here, March to August, where we started to finally see some strength, okay? Where we started to finally see strength, what was taking place from a sector rotation perspective? You can see here, consumer discretionary and technology sectors, they were the ones leading from March to August. Okay, that's very similar to what we are kind of seeing here take place. Like I said, it doesn't mean that the bottom is in, but it could be telling us that, hey, we're in this area where we could be very well coming to a market bottom, okay? Now, if I continue on and you look at the financial crisis, you can see here this big drop off, right? Boom, down into the March. And then we started finding our bottom right around here. And we started seeing some strength, right? Getting back above that 200-day moving average and so forth right from there. So what was taking place from a sector rotation standpoint there? Well, if we take a look from March 2009 to May 2009, take a look at discretionary. It started really picking up pace, up 12%. You had communication services and technology starting to catch bids too. The big outstanding ones here, because it was, a real estate crisis, those were taking the big moves. But one thing to call out here is what was the laggers? Well, it was the safety names, utilities, healthcare, and staples. Okay, so if I go back over here, you can see as the stock market tries to find a bottom in here, this is typically around the same time we enter into a recession. So where are we? And this is going to be really important to tell. And if I take a look at this is looking specifically at the business cycle. This is a time and period where I believe that we're moving into stage one, or we're in stage one, and we're trying to get somewhere down into this range over here. I don't think that we're at the bottom of the business cycle by any means as it stands. I think we're in stage one. And stage one is where stocks, commodities fall. We've seen that. Also when bonds start to move up, which we're starting to see bases. But if I read stage one, it says, shows the economy contracting. Okay, so we're seeing signs of that. And bonds turning up as interest rates decline. Okay, economic weakness favors loose monetary policy and the lowering of interest rates. Notice here, it favors it. I don't know if we're going to be getting it, but it favors the lower interest rates, and that's typically bullish for bonds. Well, as you can see here, we've seen massive volatility in the 10-year yield. It was down today, 2.69%. I mean, this thing could be right back up here tomorrow, but as it stands right now, it's kind of consolidating sideways, holding this 3.4% level, okay? And at the same time, if you look at bonds, you can see bonds have been kind of just basing out sideways. The moving averages are starting to flatten to curl up. You could potentially call this a pennant or a flag pattern, but we still have a lot of work to do here. So if bonds start turning up, what's the last thing over here was, well, we favor loose monetary policy and the lowering of interest rates. Well, the Fed yesterday, as stated in the video, that's not really their go-to. Like, that's not what they believe is going to take place, but, they are uncertain. And the market, as far as the futures market, as far as rate hikes go, they are pricing in and favoring them to start cutting rates here pretty darn soon, at least as of right now in July, they'd start to look cutting rates. So that tells me that we're moving into a contractionary phase, as Jerome Powell stated yesterday or on the prior meeting about how financial conditions could be tightening, contracting, right? Market moves down. This could tell us that, hey, we could very well be in the ballpark of finally finding a stock market bottom. Now, when I say bottom of a stock market, I do not mean that this bottom can't be taken out. I'm saying as far as time goes, we could be nearing that stage in the cycle. Okay, so I'm not to tell you how if it goes down to here, if it goes down to here, or if it never touches back down to here again. That's not what I'm trying to say. What I'm trying to point out here is the cycle is starting to become more and more clear here as time progresses. Now, if we take a look at the daily time frame for the S&P 500, let's get into some key levels and stuff. We're looking at the volume shelf profile over here. That's measuring from the stock market high. And you can see price got above that year-to-date anchor view up and started pushing back from it. So there's a couple ways to look at this right here. It could be potentially bear flagging and we start pushing away and down from that level. We'll see here if tech starts giving way of its recent gains and financials remain down, as same with like the regional banks and so forth, and energy, that could very well drag the S&P 500. That would be pretty brutal in the S&P 500. Another way to look at this is if you just say, hey, there's a trend line right here, okay, right where this volume shelf profile is, and then you could say, oh, right down here too, there's a trend line. So what we got here is a potential broadening wedge pattern. So even if it were to come down here and do something like that, somebody might come in and say, hey, look at this, it's an inverse head and shoulders forming. And then we start breaking from this volume shelf and come test over here to potentially even 420 and higher. So that's a potential opportunity right there. But as it stands, what do we need? We need to reclaim that year-to-date anchored VWAP again. It's been chopping right through those levels. If we take a look at the S&P 500 on the 15-minute time frame, this, let me see here. Actually, I'm going to show you this slide first. This was the daily expected moves. We closed within it today, right? 68% of the time. You can see we gapped up. We came above the Jerome weighted average price. It could not hold that level. It gave it back. And then we took out the low of the Fed day right here too, which is pretty wild, and we saw that nice bounce. But as it stands right now in the S&P 500, we're back below the 5-day, so it looked great this morning, changed very quickly, right? We're back below the 5-day moving average. It's starting to curl over. We're back below the month-to-date, week-to-date anchored VWAPs. We're back below the Jerome weighted average price there too. Doesn't look too healthy overall. If I look at the expected moves going into tomorrow, we're looking at 397.62 to the upside, 388.72 to the downside. So I'd be looking at these levels down here. Like I said in yesterday's brief, even if we get a big move up, be careful because it could just be flagging. This doesn't look like a bear flag. That was just a weird day overall. But we said to proceed with caution because even on a big move from overextended areas, you got to proceed with caution here. It's very volatile as it stands, okay? Now, we're going to talk about Bookmap here really quickly. These were the levels that we discussed yesterday. If you don't know what Bookmap is, think of the order book or level 2s, those numbers that flicker on the screen very quickly. This applies a heat map to it so you can visually see the data. This is what I used to trade every day, intraday, and even some swing trades. These are why I give you some of these key levels, and this is ES. Okay, S&P 500. Now, if we take a look here, this was what we went over yesterday, looking and visualizing the data of, hey, where can the key levels be? The market closed here, and then we started getting our key levels over here, the daily expected moves. Well, if we take a look at today's trading day, it came up into the upper daily expected move, and it came up into this area where we had that liquidity hiving out, and it started pushing back from that area back down to the daily VWAP. Never came down to touch the lower expected move, but we kind of bounced right back up right around that daily volume weighted average. Now, if we take a look at, okay, let's go into tomorrow's price action. Where are the hidden levels hiding? Well, we have the upper expected move at 4,028. We have the lower expected move at 39.39. They're visually on this screen. And then we have a couple areas here of higher liquidity to pay attention to. That's just above, I'd say that's about 40.15 right there. And then down beneath us, we have quite a few actually spots where it's like 39.50, 39.37. And then below that, we have 3,900, which has been a key magnet point to pay very close attention to. That's all I got for you, everybody, on today's video. It was a lot of information. Hope it helps out. See you on the next episode.